Interesting element, because obviously when you think about people like Spot Gamma, what they're basically saying to us is that their entire edge is based around the volatility surface of the stock market and of the asset market classes. And that's absolutely correct. It is a massive edge when it comes to the asset classes, as the volatility surface, the concept of how the volatility evolves, the skewing of it, the surface of the volatility, the various bumps and levels along the way, the volumes at all these different levels, is an incredibly detailed process. If you're a subscriber to Spot Gamma, there's an interview with Noel Smith of Convex Asset Management, who talks a lot about the volatility surface and how that they trade it. And this chap, Noel Smith of Convex, is basically the same. He makes markets, and he went from a market maker to a market taker. And that's normal. That's a normal process. And we've talked about that process ourselves many times. If you're a market maker and you're bidding 5, and you've got an offer in at 5.5, for example. So you're 5.5 offered, 5 bids, and somebody buys at 5.5 from you, and it's Goldman Sachs, and you go, oh shit, what's going on here? Why are they buying at 5.5? And they don't just buy 5.5, they come back in for another 50 at 5.5, and you say, no, 5.6, and they buy it at 5.6. You go, oh no, this is wrong. So you start squeezing the 5.6s and bringing up your bids to maybe 5.25 or 5.40 from 5s. In other words, fair value's just moved higher, hasn't it? And the reason why fair value's moved higher is because you've recognized somebody that is classed in your book as an informed trader has just bid 5.5s and 5.6s. And that's obviously now moved fair value. So a buyer at higher prices that is an informed trader brings you to that conclusion. Well, we can see that on price action charts. We can see that storyline about the fast candle move where they've pulled away and they've moved their fair value price. We've already talked about it. In fact, we showed you a screenshot of it a short while ago in this screen here. We talked about that process there, didn't we? Where we started to see this drive on fair value. And then obviously what that means is that the fair value is actually probably now somewhere in the middle of that area, and therefore the bid is going to come up to this price. It's unlikely the bid's going to be here, but the bid is now going to be between these two prices, and your job is to find that bid for the press. So there's a lot of information from people, whether you're interested in trading the volatility surface or not. It doesn't make an awful lot of difference. What makes a lot of difference is that you understand why they do things, because understanding the why allows people to get involved in the conversation from their point of view, from their angle. So Convex Asset Management, of course, is all about the volatility surface, and obviously Spot Gamma, by its very name, is all about the volatility surface as well. And therefore, when we look at Spot Gamma and we look at things like the Convex Asset Management Group, and we look at what they're talking about, you see them talking about this guy, and they're talking about the idea that they're trading relative to something else. Then that's obviously the key ingredient when it comes to any market, any profession. Charlie D tells you he traded the bonds relative to the Japanese yen, right? He traded bonds relative to the Japanese yen, but he was always mindful of the underlying economy. He was always aware of how the S&P was doing. So you're trading it relative to something else. You're always asking about discounts and premiums. It's not about, you've never heard a single mention of the things like stochastic was oversold or the RSI was overbought. It was always this model about whether you were buying or selling against something else, whether there was a value to bid it or not, as part of effectively a relative value trade storyline. So when you model the volatility surface and you look at implieds and you look at the correlations and you look at the various other elements, so you look at historical volatility and volatility itself, you can start to build out some of these models, even in a very simple sense, very much like the RSI we built yesterday in oil. It's a model. It might have a lot of challenges with a model, but you can still build a model. So when you build a model, you're always asking to see if there's an answer to the question. You've got the volumes that you can add into the model as well. You've got the various volumes that you can build around these as storylines, and you can start coming up with conclusions. So when I built an RSI model against the volatility surface, this is what it came out like just here. So this is the RSI model for volatility. Doesn't really matter what it is because it's just the model itself, right? It's just the idea of building a model. And the idea, of course, is you're trading volatility in this model. Well, if you're trading volatility, you're trading the underlying asset most of the time, right? What I'm trading is the blue line. So if the blue line appears at the top of the box or the blue line appears at the bottom of the box and nothing else does, the blue line was the only thing that was through the top edge at this point here, and the blue line was the only thing that was through the bottom edge here. Well, I can now make a volatility decision. I can see if that volatility decision is being met by significant increases in volume in the underlying asset. And now we've got a way of expressing that volatility premium or discount as an asset trade. So if I look at the aggregated volumes, you'll see that the volumes were actually coming into those two trades almost exactly at the right time, almost exactly. On the second one here, you can see that we're now in the right place to take that deal. So in other words, when we look at the volatility surface, and I then look at the increase in volume coming in the asset itself, now you're starting to say to yourself, there's a story developing here that has an edge. That's what we're looking for, isn't it? Now, this doesn't mean that this is a long volatility trade. What it means is that there's probably some value here for something. It could be a spread trade, of course. It could be a pairs type trade. But there's definitely value. And if there's definitely value and it's dealt around volume, and you can see if I go back a little bit, there's another surge in volatility here in the same, almost in the same area. It's one candle different, and it's only a 1 minute chart. So there's always going to be another opportunity to work that blue line there, isn't it? It's one candle different. So when we tie those areas together, we start tying those trades into these storylines, and then we ask the question, well, what did the price of the S&P do based on the volatility surface? Because this has got nothing effectively to do with the S&P. It's all volatilities against other volatilities, right? It's all slopes against slopes against slopes against slopes. So when we look at the volatility surface, and we can see that this is a sell on volatility, well, it's in volatility inverted, of course, we can start to recognize that the asset should probably sell off, because I've done this as a positive correlation to equities. So when we see that as a positive correlation to equities, the asset should sell off. Well, unfortunately, the asset was already selling off. We see another one where the asset should sell off. Look at the size of the volume there at 1900 hours coming into the market and close trades, right? Well, that was the top tick price of the S&P. The top tick price on the S&P was at exactly that 2 candle phase. And the S&P dropped significantly. And then when we got this very clear example of a bottom edge here, you can see we got this perfect bottom line rally on the S&P coming off the bottom edges there. So like everything else, the idea of building models is obviously part and parcel of every relative value trader's arsenal, isn't it? The idea of starting to build models around surfaces, the idea of building models around relative value or driving trade ideas. And it's always about these ideas, isn't it? It's always about developing out your own thought processes. It's not about copying these ones, because this has got nothing to do with anybody. It's just about the process that we're talking about here, isn't it? If we start logically building a process, it comes back to the questions that we had before. The question we had before about the linkage between the gold and the currency markets. It's a question, obviously, that's been considered by the traders in the room. It's a question that traders in the room have. It's a thought process that they're building based on an assumption that they're making. In other words, there's a background thesis, and their probability, their trade now is, or their process now is to prove or disprove the thesis, right? There's a null probability, a null hypothesis. So what we're trying to do is we're starting out with thinking about what the thesis might be. We're then going into the markets to try and prove yes or no regarding that thesis. And we're starting to recognize if there's a possible edge. We're starting to look for those linkages between bottom edges and top edges. We're starting to consider if it stands out, does it become a clear, crystal clear trade? And if the volatility is a crystal clear trade, perhaps the asset underlying the volatility might also be a crystal clear trade. We can recognize, for example, that the blue line is clearly going in the wrong direction here. And if the blue line's clearly going in the wrong direction, you can see it's only a touch away from the top edge of the RSI at that stage. And therefore, if I was going to do anything on the asset, it would be a sell trade from there, wouldn't it? And the sell obviously did come in and it did make some nice money. So whilst it might not be a sell, at least I know it's definitely not a buy trade. As I build out my models, as I build out the process of what these models are showing me, I start to gain insight that perhaps I hadn't seen before. And because I've normalized all these lines inside of the structure of an RSI, I've given myself a clarity, but I've taken away some of the ability to see longer term durations. You know, I've obviously restricted myself by bounding my narrative inside of this framework. And that's the problem with these as processes, isn't it? The problem with these as processes is now I've imposed a boundary that I've decided on, not that the market's decided on it, that I've decided on it. And that's based around the fact that you're looking at a 14 candle look back. So when we think about these as processes and we think about these as ideas and we're looking at these volatility surfaces, you can see that there is a possibility of a buy trade in here, for example. You can see that that seems to be the biggest discounted product there. And obviously into that as a storyline, you could say, well, I like this. It seems as if the blue is almost unique in its down move. Obviously, the only line that usually joins the blue line is the orange line, and you can see that from a visual, simply a visual part. And obviously, you can look at that and say, well, was there a big aggregate volume coming in? Was there N-vol coming in? Do I see any elements? And we see a lot of volume coming in as well, just literally before it happens. So obviously, when it happens afterwards, and you can see it happens a lot. See how the blue line goes up after the volume, and the blue line goes down after the volume, and we've seen that in a couple of other earlier examples. And you say, well, that's maybe them getting that spread trade on and then getting the hedge trade on. Maybe that's the manipulation of price that we understand happens all the time. So if I'm now looking at this as a buy on this line, which we know is inverted volatility, so we know that there's a sell on volatility surface. So we can quite clearly see that the volatility surface seems a little bit rich. And we could understand that that probably means that the volatility traders will short sell the volatility. Then, of course, that would probably lead us to a lower price on equities to buy into. And obviously, if we were going to buy into equities on that drop there, you would obviously be looking for the sweep to buy into equities, and that would have put you into a buy trade, perhaps there, into that dropping phase, right? Into that dropping phase there, you're now looking at the buy on equities. And sure enough, there's the buy on equities right there. So it builds a story, doesn't it? It builds a storyline around these ideas. And we can start to spot whether we're looking at, whether we're thinking, whether the idea is strong, whether the idea is weak, because none of these lines represent equities per se. All of these lines are volatilities. And when we build out that volatility surface, it's now about trying to recognize whether the volatility is plus or minus in terms of its net positioning. And as we catch up with the right-hand edge of the charts, we can see that it's in the early stages. Of course, it's all about the gaps. So it's very difficult to make a read on this at the present moment. But you can see there's no real storyline on this. The blue line still seems to be trading above some of the volatility surfaces. So for me at the moment, I don't see any reason to be buying S&P. Of course, it's down below here because it gapped down below here. And until we get basically clear of the cash open, this isn't going to show us anything. because obviously most of the cash open is now including the stuff that happened over here. So until we get clear of that stuff, then we can start seeing whether this is now bullish or bearish into this as a storyline and what we can do about it. And at the moment, I don't see any buy trade on S&P. Simply don't see any buy trade on the S&P. I don't see any value to start working into any bottom edges. And that's absolutely fine. It's not really going to develop until we get the first sort of half hour out the way anyway. But you can see that this is a model and it's a building process of the model. And once we understand the building process of the model, we can obviously start assessing whether there's any value in that model or whether we just simply chuck it in the bin. And a lot of models, the vast majority of models get chucked in the bin, right? Because most models simply either aren't provable or they're not consistent enough, or they have challenges like we saw in the oil. At the end of the day, the oil's got a massive challenge because it doesn't take into account the long term. This doesn't take into account the long term either. The difference with this one is that you're comparing like with like. You're comparing volatilities with volatilities with volatilities with more volatilities. So this has a lot more value than the oil model, if you like, because it doesn't compare outside market driving influences. It's all volatility. Every single aspect of volatility is included in this volatility model. So you really are comparing apples with apples inside of an apple framework. You know, comparing apples to pears inside of a banana framework is a little bit more awkward at times, right? So we can understand that this is how we develop out models. It's like bonds. We can compare bonds to the bond curve. We can compare bonds to the linkers. We can compare bonds to a different bond curve. We can compare bonds to another bond or a note. And they're all directly correlated. But we can also compare bonds to gold and oil and equities and the dollar. And all of a sudden, we move outside of the bond asset group. And as we move outside of the bond asset group, we start to have some problems because there's spreads that develop outside of that asset group. The dollar can be trading unique from everything else because there's a driver in that market. Oil could be trading unique from everything else because OPEC said something, and so on. So we have to remember that there are unique things that we can build. Inside the asset class of the S&P, we've obviously got the tick. Well, the tick is the S&P. We've obviously got the highs, lows. Well, the highs, lows is the S&P. So we can build these models based on the high, low, and based on the tick, and based on the prem as well, couldn't we? And we could see whether these are overpriced or underpriced and so on and so on. We could build a model around those processes. So we'll build a model around those processes, and we'll do that this afternoon as an RSI exercise that we did in the earlier classroom in oil. So that's what we said we would do today, is we'd build an S&P model using some of the market internals, using an RSI, RSI structure, if you like. And we'll do that in classroom this afternoon for anybody that's interested in building out the process of knowing and understanding the logic. And we could build a MACD model, if you liked, as well. It doesn't make any difference, but once you understand the process of building out these models, it's not so that you become model builders. It's so that you understand relationships better. A model is just about understanding about the mathematical relationship of products. It's about doing correlation coefficients against all the various asset groups that you've got available, looking at whether it's a +1 or a -1. Why is it a -1? Why does it ever become a -1? What causes that to happen? And if I see something happening, can I now know that it's going to be a -1? This is what happens when you build models. You start to ask the correct questions, don't you? You start to understand the kind of questions that now need to be answered instead of the old questions. Why did that overbought and oversold not work this time? Because it doesn't mean anything. What do you mean it's overbought? And well, it's higher than it was 20 candles ago. Yeah, but why is that an overbought condition? That doesn't mean that the market's overbought. It just means it's higher than it was 20 candles ago, right? So there's a lot of questions that you can't get answers to by simplifying processes. But if your process is complicated enough, if you're asking the right question, a lot of times you get the right answer. and suddenly things make sense. Now, in terms of volatility, I still haven't got a volatility that is exposed. So you can see on the volatility curve right now, still nothing, right? There's still nothing in the volatility curve. So when I'm looking at the asset class of the S&P, I'm still not seeing it from a volatility perspective. I'm still not seeing what the trade's going to be. So I'm still not looking to be buying or selling or trying to do anything special or trying to do anything smart at this stage. It's just a case of just letting it be and waiting for something else to show up. Now, of course, I could take it off the 1 minute chart and drop it down into the 30-second chart and so on and so on. But that's neither here nor there. It's the model